Okay, so you want to own a ski resort. A log cabin lodge glowing at the base of a mountain, chairlifts hauling happy skiers up snow-covered runs, and a captive audience willing to pay premium prices for a single perfect powder day. You picture a glamorous Alpine empire, real estate appreciating around your base village while lift tickets fund an endlessly growing operation. Sounds simple. It is not simple. Here is what nobody tells you before you buy that mountain. The single day lift ticket sitting at the ticket window is not actually meant to be sold. Your entire business depends on a substance you cannot manufacture reliably, and one of the largest ski conglomerates in American history borrowed its way into building a genuine empire before collapsing into total dissolution, sold off resort by resort until nothing remained. So let us take apart what actually happens when you own a ski resort. Let us start with the number that makes almost every other business on this channel look modest by comparison, the chairlift itself. A single new chairlift costs anywhere from $2 million to $10 million, and a mid-sized gondola system can run $10 million to $30 million, with the most advanced high-speed detachable lifts in the largest resorts regularly exceeding $20 million apiece. A single high-speed 8-person chairlift installed at Big Sky Resort in Montana cost roughly $75,000 per chair across 64 chairs, totaling $4.8 million for one lift alone, and the most expensive lift systems in the world, built for extreme terrain and weather, have crossed $80 million. And unlike almost any other piece of commercial infrastructure, this equipment has to operate reliably in extreme cold, ice, and high wind, carrying more than 250 passengers at any given moment up a steep, exposed mountainside, which drives every safety and engineering standard and every dollar of cost dramatically higher than a comparable structure built at sea level. But here is the invisible engineering cost that separates a functioning ski resort from a mountain with a chairlift bolted onto it: snowmaking infrastructure. Capital costs for snowmaking equipment range from $500,000 to $5 million, depending on how much guaranteed coverage a mountain actually needs, because natural snowfall alone is no longer a reliable enough foundation for a business this capital intensive to depend on. Add land acquisition, which varies enormously by region, but represents a serious, often multi-million-dollar commitment before a single lift tower goes into the ground. Add access roads, parking infrastructure, and utility connections running electricity and water up a mountainside that had none of it before. And add permitting that in the United States frequently means navigating Federal Forest Service land use approval, a process that alone can take years and cost hundreds of thousands of dollars in environmental review before construction even begins. None of this is optional, and none of it is visible to a skier riding the lift, because a ski resort is fundamentally a piece of extreme weather industrial infrastructure wearing a cozy alpine lodge as its public face. Grooming equipment adds another quietly expensive layer to this budget, because keeping a mountain's terrain skiable and safe requires a fleet of specialized snowcats, each running several $100,000, operating through the night every single night the resort is open, regardless of how many guests actually skied that day. Avalanche mitigation infrastructure, explosive charges, remote-triggered systems, and trained patrol teams certified specifically in avalanche control represents a further specialized cost most first-time resort investors never budget for accurately, precisely because it sits invisible behind the scenes, only becoming visible to the public on the rare occasion something goes wrong. So the lifts are spinning, the lodge fire is lit, and now the daily grind of keeping this operation solvent begins, because a ski resort carries one of the most punishing fixed-cost structures of any seasonal business on this channel. This is operating leverage measured in kilowatts and gallons of water. Lift maintenance and operational costs alone run $200,000 to $1 million annually per resort, depending on how many lifts you operate and how complex they are. And that bill arrives regardless of how many skiers actually rode those lifts that week. Snowmaking compounds this relentlessly, costing $200 to $1,000 per inch of artificial snow produced on a given day, not counting the labor to run the equipment, while overall energy and utility costs for buildings, lifts, and snowmaking together run $500,000 to $3 million annually, and maintaining that snowmaking equipment specifically adds another $100,000 to over $1 million per season in electricity, water, and labor. Payroll adds a brutal seasonal twist unique to this industry, because a resort needs a full roster of lift operators, ski patrol, groomers, and instructors staffed and ready from opening day. regardless of whether that particular week brings a powder day crowd or a nearly empty mountain. Ski patrol in particular is not an optional cost center. It is a legally and morally non-negotiable safety function that has to be fully staffed every single operating hour. None of these costs pause during a slow Tuesday. The snowmaking guns still run through freezing overnight hours. The lift motors still draw power holding position for the morning rush, and the payroll for a full patrol and lift operations team still clears, whether the mountain drew a packed holiday weekend or a quiet, half-empty midweek session. Insurance adds a further layer of relentless fixed cost. Because a business built around high-speed machinery hauling passengers up steep terrain, combined with an inherently risky sport practiced by guests of wildly varying skill levels, carries liability exposure that dwarfs almost any comparable seasonal business. Workers' compensation for ski patrol, lift operators, and grooming crews working in genuinely hazardous winter conditions runs meaningfully higher than equivalent roles in almost any other industry, and general liability coverage for guest injuries, an unavoidable feature of any mountain sport, represents a permanent, non-negotiable cost that scales with visitor volume, but never disappears entirely, even during the lowest traffic weeks of the season. So how does anyone actually turn a profit on a business this exposed to weather and fixed costs? This is the popcorn business moment, and the ski industry has built one of the most deliberately engineered versions of it on this entire channel. Here is the mechanism, laid bare. A single-day lift ticket at a major resort now regularly costs between $300 and $350, a price that has climbed dramatically in recent years, while a full season pass covering dozens of resorts sits at roughly $1,000 to $1,400. That single-day ticket is not actually meant to be sold in meaningful volume. Its entire purpose is psychological, making the season pass look like an obvious bargain, since a skier breaks even on that pass after skiing only about 4 days. Why would an owner price the core product so aggressively that almost nobody rational buys it at face value? Because the real business was never the individual lift ride, it was the pre-committed, non-refundable cash collected months before a single snowflake falls. Season passes now account for roughly 65 to 75% of total lift revenue at the largest operators, and that revenue is collected and locked in by mid-December, well before anyone knows whether the coming winter will deliver a banner season or a disaster. This is yield management in its purest form, transforming a business that used to live entirely at the mercy of weekly snowfall into one that has already secured the majority of its revenue before the risk period even begins. The mountain itself, and even the real estate development surrounding many resorts, functions almost as a loss leader in this equation, since detailed financial analysis of the industry's largest operator found skiing itself drives over 85% of total revenue and 95% of total profit, while the lodging and real estate operations sitting around the base village consistently lose money or barely break even, existing mainly to keep guests on property and locked into the ecosystem rather than to generate profit in their own right. There's a second, quieter layer to this same yield management strategy worth naming directly: behavioral lock-in. Data from the largest multi-resort pass programs shows pass holders ski 2.5 times more days on average than guests who buy single-day lift tickets, which sounds like a customer benefit but is actually a retention mechanism working exactly as designed. Because a skier who has already sunk over $1,000 into a season pass feels compelled to extract value from that purchase by returning again and again throughout the winter. Each of those additional visits generates incremental on-site spending on food, rentals, and lessons that would never have happened under a pure single-ticket pricing model, which means the season pass is not simply a hedge against bad weather, it is also a psychological device engineered to manufacture loyalty and repeat visitation that a resort could never generate through ticket pricing alone. Now, here is the trap door under the floor, and even the most sophisticated pre-sold season pass strategy cannot fully close it, weather itself. A ski resort's entire product depends on a specific, narrow band of temperature and precipitation that no owner, no matter how well capitalized, can manufacture on demand when nature refuses to cooperate. During one recent historically weak snow season across the Rockies, skier visits at the largest operator fell nearly 12%. And even with the season pass buffer absorbing most of that shock, net ski resort revenue still declined by over $50 million in a single quarter, with dining, retail, rental, and ski school revenue all falling alongside it as fewer people showed up to spend money once they arrived. The pass strategy softens this blow considerably. but it does not eliminate it, because pass holders who already paid still have to physically show up and spend money on food, rentals, and lessons for that on-site revenue to materialize. And a warm, snow-starved season keeps them away regardless of what they already paid months earlier. Layered directly on top of that weather dependency sits a second, equally uncontrollable risk: the enormous fixed debt most resorts carry to finance the lifts, snowmaking systems, and real estate ambitions we already walked through. A resort financed with meaningful leverage against multi-million-dollar chairlifts and snowmaking infrastructure has to service that debt every single month regardless of snowfall, which means a run of a few consecutive weak winters, the kind that occur naturally and unpredictably in any multi-decade climate record, can turn a comfortable debt service coverage ratio into a genuine solvency crisis with almost no warning beyond a disappointing weather forecast. There is a third dimension to this trap that has grown sharper in recent years: the concentration risk baked into the multi-resort pass model itself. Because a handful of large operators now control the two dominant season pass ecosystems that most serious skiers rely on, an independent resort's own pricing and revenue strategy has become increasingly entangled with decisions made by a competitor's corporate headquarters rather than purely by local conditions. That same dynamic has recently drawn regulatory scrutiny, with lawsuits alleging that aggressively pricing single-day lift tickets specifically to make season passes look unavoidable functions as a form of anti-competitive bundling. A legal risk that did not exist for this industry a decade ago, and one that no individual resort operator has any ability to manage on their own, since the pricing strategy driving that litigation originates at the corporate parent level rather than at any single mountain. Let us talk about American Skiing Company, once the largest ski resort conglomerate in the United States, built by Les Otten, a former Killington employee who purchased Sunday River in Maine in 1980 with $840,000 in financing. Otten's success at Sunday River fueled an aggressive acquisition spree throughout the 1990s, buying Attitash Bear Peak, then in 1996 making his biggest deal yet, a $107 million bid for SKI Limited that brought Killington, Mount Snow, Haystack, and a majority stake in Sugarloaf under one roof, officially forming American Skiing Company. The empire kept growing, adding the Canyons in Park City, Utah, and developing Steamboat in Colorado and Heavenly near Lake Tahoe. And in November 1997, the company went public, with stock opening at $18 a share on the strength of what looked like an unstoppable growth story. The stock never regained that opening price, and the cracks were already visible underneath the acquisitions. By fiscal 1998, the company posted a nearly $7 million operating loss while carrying more than $400 million in total debt. A direct result of financing an aggressive, multi-resort buying spree almost entirely with borrowed capital rather than earned equity. The weather trap we described earlier hit hard in 1999. A season of poor skiing conditions colliding directly with that already crushing debt load, forcing Sunday River employees to take unpaid leave and Sugarloaf staff to accept furloughs or 20% pay cuts just to keep the company afloat. Oak Hill Capital Partners, backed by Texas billionaire Robert Bass, pumped $150 million into the struggling operation to buy time, but the underlying math never recovered. Beginning in 2006, American Skiing Company entered a slow-motion dissolution, selling off Steamboat that December, then announcing the sale of Killington, Pico, Attitash, and Mount Snow in February 2007. Otten himself resigned from the board and attempted an unsuccessful bid to buy back Sugarloaf and Sunday River, the two resorts where his entire career had begun. By September 2007, American Skiing Company filed papers with the Securities and Exchange Commission, formally dissolving the company entirely. The lesson is not that acquiring multiple ski resorts is inherently reckless. The lesson is that stacking debt-financed acquisitions and ambitious real estate development on top of a business already fundamentally exposed to weather can turn a genuinely successful mountain empire into a company selling off its own founding resort, one piece at a time, to satisfy creditors. The broader pattern here extends well beyond one company's specific missteps, because American Skiing Company's collapse illustrates a structural vulnerability that still applies to any resort operator financing growth primarily through debt rather than earned cash flow. Otten's original insight, that a single successful mountain's cash flow could fund the acquisition of another, was not itself flawed. Sunday River's early success genuinely demonstrated real operational skill. What broke the model was scale outpacing discipline. Each new acquisition adding fresh debt service obligations on top of a business still fundamentally at the mercy of a single, unpredictable variable, snowfall, until enough consecutive average to poor winters arrive to make the entire capital structure unsustainable, regardless of how well any individual resort within the portfolio happened to be managed on the ground. Let us run the numbers on a mid-sized regional ski resort. Optimistic scenario against realistic bad year. In the optimistic scenario, your season pass sales run at or above the industry-leading 70% share of total lift revenue, locking in the bulk of your season's cash well before the first snowfall. Your snowmaking system is well capitalized enough to guarantee reliable coverage even through a marginal natural snow year, and skier visits land near your historical average, driving strong on-site food, rental, and lesson revenue on top of your locked-in pass income. Against a construction and equipment investment in the tens of millions of dollars for lifts, snowmaking, and base infrastructure, a well-run mid-sized resort with disciplined pass-driven revenue can produce net operating margins in the industry's healthier 10 to 20% range, supporting a payback period stretching well beyond a decade, typical for infrastructure-heavy seasonal businesses. Now, the realistic bad year. A historically warm, low-snowfall winter arrives exactly the way it did across the Rockies in one recent season, and even with the majority of your lift revenue already locked in through pre-sold passes, skier visits still fall by double digits as pass holders simply choose not to make the drive. On-site revenue, dining, retail, rentals, and ski school falls even harder than pass revenue because that spending only happens when guests physically show up, and a warm, patchy mountain keeps them home. Snowmaking costs spike as your team burns through electricity and water trying to compensate for the missing natural snow, precisely the moment your on-site revenue is already declining. Your fixed costs, the lift maintenance contracts, the ski patrol payroll, the debt service on your chairlifts and snowmaking infrastructure, do not move by a single dollar in response to any of this. Net profit margin can compress from that comfortable 10 to 20% range down into the low single digits, or in a genuinely severe multi-year weather stretch combined with heavy leverage, into an outright loss resembling the exact conditions that pushed American Skiing Company toward dissolution. The difference between these two scenarios on a mid-sized resort can easily exceed several $1 million in a single season, and for an owner carrying meaningful construction and acquisition debt, that swing is precisely the kind of gap that turns a comfortable debt service coverage ratio into the same downward spiral Les Otten's company experienced decades earlier. So what is a ski resort once you strip away the Alpine Lodge and the Powder Day Instagram photos? It is a machine that turns a non-refundable bet placed months in advance into a hedge against a substance, natural snow, that no owner can actually control or guarantee. The single-day lift ticket sitting at full price is barely a real product. It is a psychological anchor engineered to make the season pass look irresistible by comparison, while the pass itself functions as the true business, locked-in cash collected long before the risk period even begins. The mountain, the lodge, even the glossy real estate surrounding the base village are mostly loss leaders and amenities designed to keep that pass holder coming back winter after winter. You are not really buying a mountain covered in snow. You are buying a bet that enough people will keep paying you up front for the promise of winter, in a business where the actual winter, the thing your entire product depends on, remains completely outside your control no matter how many millions of dollars you pour into chairlifts and snow guns.